The greatest scholars are not usually the wisest people. Geoffrey Chaucer. Please remember, I am not.
Frankly, U.S. Treasuries have been the go-to assets for global portfolio managers for the better part of 20 years. They've particularly been attracted to them as a safe haven in so-called risk-off periods. Look at the period surrounding the great financial crisis. Look at all the green above the line. Something stunning happened last March. In the middle of the equity meltdown, foreigners aggressively sold treasuries as we proposed the CARES Act. So I'll never forget it. Right in the middle of the worst part of the equity meltdown, in the third week of March, there was an 18-point decline in the bond market. We didn't know what it was at the time, but we found out months later through Fed accounts that foreigners had sold $1 trillion worth of bonds in response to the CARES Act. Again, this has never happened before, but they are watching our behavior, most of which I've outlined in the last 5 or 10 minutes, and they're frankly saying no mas. Asians and others have been purchasing Chinese assets who have done no QE and much less fiscal stimulus in response to COVID, and they're doing just fine, thank you very much. With China representing 20% of world GDP and only 1.6% of global portfolios, and the US representing 25% of GDP, but 28% of world portfolios. Remember, China 1.6%. This process is probably early rather than late. And the last thing the US needs is interest rate burdens. As the last few administrations have refused to mitigate the growth in entitlements, knowing that we were entering a great boom as baby boomers turned 65, debt to GDP was already set to cross 100% in the next decade.
When the U.S. government announced the CARES Act, the bond market sold over $1 trillion in bonds. It turns out that foreigners holding U.S. debt said no more to loose monetary and fiscal policy. The U.S. was somewhat saved because the technology companies that thrived during the COVID lockdowns, the FANG stocks, are American companies, and dollars transferred from the bond market to the U.S. equity market. Now wealth is finding a home in China's financial assets because the Chinese government did not give QE or stimmy checks. China has 20% of world GDP and 1.6% of global portfolios, while the US has 25% of world GDP but 28% of world portfolios. In other words, China is producing more with less debt than the US. When England lost its reserve status of the pound, it did not happen overnight. It happened over time and followed a trend. The US is following a trend: high inflation, easy money, low GDP. Money is production, and since the US dollar is needed for world trade, there is always a demand, yet the US has low growth. The rest of the world exchanges their goods for dollars, and as Stan Drunkemiller stated, foreigners are starting to say no mas, or no more. The world is starting to reject the reserve currency, and every time in history that there was a fundamental change to the global economy, there was a fundamental change in every aspect of life. Crypto is a transformative technology and is the next evolution of money. With crypto, fiat can be unpegged and there is no longer a need for a reserve currency.
Through trial and many errors, we found a partnership in which the private sector, namely banks, create most of the money, but in which central banks use the price of money to control the demand for money creation, in order to ensure that the growth in the stock of monetized obligations is in line with what the economy can produce. We learned at great cost both that a fixed stock of money, in other words, the gold standard, is out of line with a dynamic and growing economy. And we learned that the unconstrained money creation destabilizes money itself. If on balance, people have confidence in the money they use, this is due to the credibility of this institutional framework, including the public's recognition that central banks at the core of the system are on their side. We should never take this trust for granted. The financial crisis was a reminder that in the end, that money is, to quote the words of John Cunliffe, Money is, in the end, a social convention that can be very fragile under stress. Moreover, technological change is widening wealth and income inequalities. And through social media, technological change is contributing to the polarization of public opinion. To many people, the necessary monetary stimulus of the past decade is perceived to have widened wealth inequalities, putting further pressure on public consent. And into this heady mix comes competition from a burgeoning array of new private currencies that threaten to disrupt monetary and financial stability. Money can change because of fundamentally transformative innovations, including advances in cryptography and artificial intelligence, as well as the powerful network effects in social media. But most fundamentally, money needs to change to serve the new economy.
Fractional reserve lending. Every dollar the Fed prints, the bank can lend out 10. The Fed is forced to inflate to keep the system running, and this has a ripple effect on inflation due to the 10x leverage. With crypto networks, the wheels can stay in motion without the need to create money. Trustless lending and borrowing, eliminating Nostro and Vostro accounts. The inefficiencies in the banking system is the reason banks need the 10x leverage. If capital is no longer locked in the banking system and less is spent on intermediaries, the capital can be used in more productive means. An efficient banking system without trust and cost of 3-day settlement times. This is transformational. A more efficient banking system, a more efficient global economy.
Charlie, you said communist China is doing all the things that we should be doing right now, and I can't help but think of what they've done to Jack Ma.
It amuses me, you know.
Well, what about what they've done to Jack Ma? He's kind of disappeared as...
Well, yes, but Jack Ma's one of the swingers. So they just they said, the hell with you. He basically gave a speech when he said to a one-party state, well, you guys are a bunch of jerks, don't know what you're doing, and I know what I'm doing, and I'm going to do it better. And he was going to wade into banking and no rules and just do whatever he pleased.
He also brought banking to a lot of
the
unbanked
Chinese
people.
communists did the right thing. They just called in Jack Ma and say, you aren't going to do it, Sonny. And I wish we had I don't want all of the Chinese system, but I certainly would like to have the financial part of it in my own country. The financial part of it in my own country. The financial part of it in my own country.
Charlie Munger agrees that the Chinese Communist Party did the right thing to Jack Ma. Jack Ma criticized Chinese banks and then disappeared for a couple of months. You simply do not speak out against the banking cartel. Charlie Munger is envious of the updated financial system China has. China's financial system does not run on legacy systems like the U.S. Their financial system has been built by Ant Financial and Alibaba. It started off on the internet and does not have the history of the legacy systems like the U.S. banking system does. The super elites of the U.S. are envious of China's financial system. Maybe this is why Berkshire and Hathaway are investing in big banks like Bank of America that is also head of the Ripple's Global Payment Steering Committee.
As the BIS observes, existing bank-based payment rails are expensive, even if those costs are not visible to consumers. Commercial bank money will therefore largely be used as a remunerated store of value, and this will have implications for bank funding, credit intermediation, and the oversight of market-based finance, issues to which I'll return to in a moment. But to be clear, these higher funding costs should not dissuade central banks from pursuing reforms that offer the public greater choice and better service. Banks are a means to an end, not ends in themselves, and they'll have to adapt to a much more competitive environment.
RippleNet is a solution for the smaller and medium-sized banks to offer cross-border payments. On the XRP ledger, banks can issue IOUs with any fiat currency that is needed. It's an updated system that does not use the legacy rails and lives on the internet. There are 300 plus banks on RippleNet currently. There is a network effect, and the more banks that join, the richer the network. This decentralized payment system is ready and available for banks to use for cheap and efficient cross-border payments. Ripple does not remove the trust relationships required in correspondent banking system, but simply shifts them to other parties, the gateways. This limitation could be removed as such a system would use central banks to act as gateways, since the currencies issued on Ripple would then actually correspond to the actual currencies. This would remove all trust requirements for settlements other than the trust in central banks, which is a necessity in any case when transacting in corresponding currency. If central banks agree to be the gateways on RippleNet, overnight there could be a SWIFT 2.0, a fully regulated platform that all banks can compete on a level playing field. Additionally, banks would not have to develop, test, and spend for their own systems. Simply plug into RippleNet and use an open-source decentralized technology, the XRP
We're seeing
ledger.
an enormous amount of interest from traditional hedge funds, family offices, and banks, frankly, who are looking to transform their current offering to get into digital assets, but wanting to do it through trusted partnerships and wanting to do it through regulated entities. And so coming from a background of traditional capital markets, partnering with folks like Cowen, we're finding that there is the ability to take interest in varying degrees that's been there, but to really accelerate the adoption by being able to do that with counterparties that they know and counterparties who understand their core business. And we also have some bigger ideas around settlement that would be cross-asset class and cross-chain, really to build an interoperable settlement layer that we are in some proof of concepts right now that will direct some of the funding that we've raised towards further building out those initiatives.
PolySign is gaining interest from banks, hedge funds, and crypto exchanges. PolySign is a bridge from the old world to the new world of tokenized assets and crypto. It's regulated and custom tailored for institutions to use. The team members of PolySign came from traditional markets, and this custom-tailored solution for banks and hedge funds has accelerated because PolySign is using counterparties that the banks know and trust. PolySign partnered with Cowen, an American multinational independent investment bank and financial service company that was founded in 1918. Jack hints around a settlement layer that's cross-asset class, cross-chain, that's an interoperable settlement layer. If you recall David Schwartz on Thinking Crypto, David describes XRP as a liquidity pool that can be paired against illiquid assets.
Today, after another crisis, the choice isn't whether or not to peg the currency, but the stakes are nearly as high. The world's changing rapidly. It's less hegemonic and more multipolar, less analog and more digital, less destructive and more sustainable, less centralized and more dispersed, less bank and more market. The old normal of cash, bank-based finance, and bank payments rails is crumbling. And with a palette that includes a new form of public money linked to a plethora of new dispersed private networks, central banks can paint a new finance that will make payments significantly cheaper and faster, a new finance that can create new forms of ownership and asset classes, power contingent payments and distributed finance, and integrate decentralized networks that help track and reduce carbon emissions. By being resilient, dynamic, inclusive, and sustainable in these ways, the new art of money can serve everyone across this new world.
The man that announced at Jackson Hole in the U.S. that the dollar would be dethroned by a hegemonic currency is now telling us that the system is going to transform and adopt new decentralized networks. He said that the old world is crumbling and it's less bank and more market-driven. The choice is not to peg the currency, but for CBDCs to directly interact with the decentralized networks, finance and payment networks. The old banking model of central banks lending to big banks is going to change. The central banks are going to issue digital currencies and back the decentralized networks to perform operations that normally banks would perform. Targeted money creation without spilling over into other areas.
With respect to crypto, only the niche will survive. With limited use cases, crypto assets will, by definition, not be that valuable, unless they're the winners of the coordination game of searching for extrinsic value in digital gold. Ultimately, crypto either has such extrinsic value without a use case, or has a use case as an NFT that perfects ownership, which is niche by definition in that it is non-fungible. NFTs would link to the payments ecosystem by exchangeability into CBDCs, creating an ability for new portfolios of a much wider set of intangible assets. Excuse me. Now, this is not to dismiss either NFTs or decentralized finance, quite to the contrary. Their scope of application is exceptionally broad, but it is to stress that tokens at the heart of programmable networks will have to remain just that, of token value. Value will be exchanged through CBDCs that link such networks to the broader financial system.
Mark Arney says that only the niche will survive. In a prior interview, he says certain native tokens will have a role, like Ethereum and Ripple.
With respect to crypto, only the niche will survive.
There are rules for what are called native currencies in smart contract networks and some wholesale finance opportunities. And so you see a lot of activity around that based off of Ethereum or Ripple.
There is an epic amount of debt. The cracks of the system are being exposed. The banking system is fragile. Understand that the last time we had this ratio of debt to GDP, there was a world war. The economic data supports a paradigm shift. Crypto assets and decentralized networks are fundamentally changing the banking system to a trustless automated system. The central banks are going to create CBDCs and allow on-ramps to these trustless systems. The trustless systems will take the place of banks without the need of 10-to-1 fractional reserve lending. This will give the central banks complete control over the economy. We are witnessing a paradigm shift. The guilty think all talk is of themselves. Geoffrey Chaucer. Thanks everyone for watching. If you liked this video, please take a moment to hit the thumbs up and be sure to subscribe to my channel. If you're interested, I have a Patreon where I post the videos earlier while I'm putting the finishing touches on the YouTube version. My Patreon offers Discord access and information that I gather for the production of my videos, as well as a weekly Zoom meeting where we have a general crypto discussion.